Welcome to vTalkInsight Allocator's Lens Daily for December 11th, 2025. Global markets are navigating the intersection of a divided Federal Reserve, surging long-term yields, and one of the strongest precious metals rallies in years, all against the backdrop of an AI-driven investment boom and rising geopolitical risk. Today we will connect how that mix is shaping the risk and opportunity set across equities, rates, credit, foreign exchange, and commodities from a portfolio perspective. Equity markets are still trading close to record levels, with the S&P 500 edging higher again and implied volatility holding in the mid-teens. That price action tells you that, despite the noise in bonds and geopolitics, investors are still leaning on equities as the main engine of portfolio returns. Several supports underpin that stance. Forecasts point to a constructive setup for United States equities into 2026, helped by expected earnings growth, ongoing fiscal support, and a powerful capital market cycle that keeps funding open for corporates. The Federal Reserve has even nudged its own growth outlook higher, toward just over 2%, which lines up with optimistic private sector expectations and reinforces the idea of an investment-led expansion rather than an imminent downturn. Within that backdrop, the AI theme remains central. Corporates are penciling in mid-single-digit to high single-digit annual boosts to sales and profits from AI over the next few years, driven more by efficiency gains than by immediate headcount cuts, and large tech firms are committing tens of billions of dollars into data centers and digital infrastructure globally, including in India. Institutional flows validate the story, with big pension plans increasing exposure to leading AI hardware names, and companies like GE reporting strong earnings, buybacks, and dividend growth tied to surging electrification and data center demand. At the same time, there are signs that leadership may broaden. Views are building for rotation into consumer-related sectors that have lagged the AI complex, especially in early next year, while large United States banks are expected to deliver double-digit earnings growth through 2026 as deregulation and capital markets activity support loan demand and fee income. The counterpoint is that this all looks increasingly late cycle. Valuations are elevated, particularly in AI-linked names, and some voices now openly discuss bubble risk if fundamentals do not catch up with price. Policy uncertainty adds another layer. The Fed has already cut rates by around 175 basis points, but its latest move came with an unusually large number of dissenting votes and a dot plot that implies only one more cut next year, with several officials even contemplating no move or a hike. That mix of a still supportive macro story, high starting valuations, and unclear policy glide path suggests a bull phase that could continue, but with more volatility and sector rotation. For allocators, the key equity watch points are bond market volatility, any sustained widening in credit spreads, and whether AI-related earnings and power constraints evolve in line with today's high expectations. Moving to rates, the central tension is between a Federal Reserve that is easing at the front end and a bond market that is demanding a higher premium at the long end. The Fed has now delivered around 175 basis points of cumulative cuts, including a fresh quarter-point reduction justified by softer labor data and moderating inflation. And it has started purchasing short-term treasuries again to keep reserves ample and money market stable. Yet the committee is clearly divided. The latest decision saw 3 dissenters and several members arguing against further cuts, while the official projections point to only one more move next year and even contemplate the risk of renewed tightening. Markets have responded by scaling back expectations to roughly a single cut, now pushed into late next year, and by bracing for a long pause. Despite that easing, long-term yields have moved higher, not lower. 10-year treasuries are trading around 4.2% and 30-year yields near 4.8%. Levels not seen since 2009, and yields across the curve are roughly 15 basis points above recent lows. Steepening is now a global story, reflecting persistent fiscal deficits, heavy issuance, and questions over how much central banks can or will do to suppress term premia. In the United States, government debt is rolling over at higher interest rates, while new borrowing needs remain large, which keeps supply pressure elevated. Technical levels matter here. Some see resistance for the 10-year yield just above current marks, but equities are thought to be more vulnerable only if yields push toward 4.5%. More than the precise level, however, it is bond market volatility that poses the bigger risk to multi-asset portfolios. Underneath the yield moves, the inflation picture is mixed but generally drifting lower. Headline and core PCE sit in the high twos, with goods prices now softening again, while services inflation remains sticky around 3% and wage growth still runs above pre-pandemic norms. Several policymakers argue that much of the earlier overshoot came from tariffs and should fade, and recent data on online and goods prices supports a disinflationary tilt over the next few quarters. At the same time, structural forces like demographics, ongoing fiscal expansion, and the cost of energy transition raise questions about how low inflation can sustainably go. Liquidity complicates the picture. The Fed is buying sizable amounts of Treasury bills for reserve management and has removed aggregate limits on standing repo operations, which should backstop funding markets. But critics worry this increasingly blurs the line with debt monetization, especially as long-end yields and gold rise together, and that perception itself can influence term premia and the dollar in the months ahead. Credit markets remain a key hinge between rates and equities. Spreads are still historically tight, which supports risk assets and confirms that investors have not yet shifted into full risk-off mode. Investment-grade corporates look fundamentally solid, with healthy profitability, prudent cost management, and limited evidence of rising defaults, while mid-quality credit is expected by some to fare relatively well as excess supply weighs on the very highest grade paper and the weakest issuers struggle more. At the same time, the very tightness of spreads limits the cushion against shocks. Any meaningful widening from here could quickly reprice risk across sectors and spill back into equities, particularly given how much leverage has been built up during the long low-rate period. The AI investment cycle is an important new driver of credit demand. Estimates point to roughly $3 trillion of AI infrastructure spending over 5 years, with about half expected to be financed through debt markets. Major tech firms are already issuing at scale to fund data centers and power projects, and individual names have seen their credit default swap prices move higher as investors question how much leverage is sustainable, even though strong earnings could eventually ease those concerns. Banks sit at the center of this funding machine. Large United States banks anticipate mid-single-digit growth in net interest income next year, helped by rising commercial loan demand and some regulatory easing that boosts lending capacity and supports more M&A and IPO activity, even as rising technology and integration costs eat into margins. Outside public markets, private credit is generally viewed as constructive and stabilizing, but United States credit overall is seen as fairly valued, which is pushing some allocators to look more closely at opportunities in Europe and Asia. Flows underline the search for income. Multi-sector fixed income funds have seen record demand this year as investors prioritize carry, taking advantage of higher all-in yields while trying to diversify across duration and credit buckets. The risk is that this benign backdrop encourages increasingly aggressive structures and leverage just as sovereign funding strains are becoming more visible. Key signposts for the credit complex now include spread behavior around large new issues, credit default swap pricing for heavily AI-exposed borrowers, and any shift in bank appetite for balance sheet risk. In foreign exchange, the narrative is more nuanced than a simple strong or weak dollar story. On one side, there's a growing view that the United States currency could be at or near an important peak in early 2025, especially if United States yields grind lower and the Fed eventually resumes cutting after a pause. A softer dollar and lower United States yields would be a constructive backdrop for emerging markets, particularly for local currency debt and risk assets, and some analysts see that environment extending through 2026. On the other side, recent price action has shown the dollar firming against European currencies despite hawkish rhetoric from some European central banks, reflecting skepticism about Europe's growth prospects and the reality that United States inflation is still running close to 3%. Geopolitics and fiscal trends are quietly reshaping how investors think about reserve currencies. Long-dated United States yields and gold prices have both moved higher since the last Fed meeting, which many interpret as a signal that markets are questioning the long-run trajectory of United States fiscal policy and, by extension, the dollar's unquestioned dominance. European moves to leverage frozen Russian assets in negotiations over Ukraine, increasing strains in United States-European political relations, and ongoing frictions between the United States and China over AI chips and technology transfers all add to the sense of a more fragmented monetary order. Those forces do not imply an imminent shift away from the dollar, but they help explain growing interest in alternative stores of value and in regional hubs that sit outside the traditional Western financial centers. Digital assets are becoming more integrated into that global capital mix. In the United States, the derivatives regulator has issued guidance that allows tokenized versions of Treasury bills and money market funds to be used as collateral, and a pilot program now permits Bitcoin, Ether, and dollar-linked stablecoins to back margin on regulated venues, subject to tighter reporting and risk controls. Meanwhile, Abu Dhabi and the wider UAE are positioning themselves as hubs for high-frequency trading and blockchain infrastructure, helped by clear government support and a desire by many firms to avoid current regulatory frictions in the United States. For allocators, FX and crypto together are evolving into a barometer of where capital is most welcome and how policy choices are shaping cross-border flows. Watch points here include the pace of any dollar softening, emerging market currency performance, and regulatory headlines on both sides of the Atlantic and in Asia. Commodities, and especially precious metals, are sending their own strong signal about the macro regime. Silver has surged to above $60 an ounce and has outpaced gold by a wide margin this year, while gold itself has been remarkably resilient. That strength reflects a combination of factors: expectations for further monetary easing over time, a relatively soft dollar backdrop, supply constraints in silver, and rising interest from both retail investors and wealth managers. It also mirrors concerns that large fiscal deficits and renewed central bank bond buying could eventually debase fiat currencies, which is why some market participants argue for a meaningful strategic role for gold as a diversifier when thinking about long-term portfolio resilience. Beyond precious metals, broad commodity indices have broken above key medium-term trend measures, prompting a more positive stance on the complex excluding crude oil. The demand story is being reshaped by AI and the energy transition. Surging electricity needs from data centers are driving investment in large, often off-grid natural gas power projects, particularly in regions with abundant gas like West Texas, and this reinforces the role of traditional energy even as economies decarbonize. The International Energy Agency has extended its oil demand growth outlook all the way to 2050, while companies like Chevron have brought project break-evens down sharply, meaning supply can respond at lower prices, which changes the risk profile for both oil and gas producers. Near-term, lower gasoline prices in the United States are easing pressure on consumers, even as upcoming fiscal measures, such as retroactive tax refunds, could give spending a temporary boost and potentially restoke some inflation later on. Geopolitics remain a wild card. Incidents like the seizure of an oil tanker off Venezuela and ongoing debates over Russian assets and Ukraine funding highlight how quickly supply expectations can shift, feeding into both energy prices and risk premia. Across commodities, the common thread is that they now sit at the crossroads of inflation hedging, geopolitical insurance, and direct exposure to the AI and infrastructure capex cycle. For multi-asset portfolios, that makes metals, energy, and broader raw materials, an increasingly important set of indicators for the durability of today's growth narrative and for the credibility of fiscal and monetary frameworks. Stepping back across assets, the picture is of a late cycle but still growth-supportive world. Equities are underpinned by AI-led earnings optimism and strong banks. Yet they sit on top of tight credit spreads and an increasingly demanding valuation and policy backdrop. Rates are doing the heavy lifting in price discovery, with a divided Fed easing at the front end while long-term yields and term premia rise on fiscal and supply concerns, steepening curves globally. Credit remains supportive but offers a thinner buffer, especially as AI capex and sovereign borrowing compete for funding. In FX and digital assets, a gradual shift away from a one-way strong dollar narrative and the build-out of tokenized collateral frameworks point to evolving capital flows, while commodities led by silver, gold, and AI-driven energy demand sit at the junction of growth, inflation, and geopolitics. For allocators, the key watch points now are long-end yield dynamics and bond volatility. Any inflection in credit spreads, the path of the dollar versus emerging markets, and whether the AI investment story continues to translate into real earnings and power investment rather than just higher leverage. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.